Welcome to Non-Beta Alpha. I'm Ryan Morphin. On today's episode, we have Bryan Mick, the founder and CEO of Mick Law, a due diligence firm that focuses on broker-dealers, RIAs, and family offices and their allocation into alternative investments. This is Non-Beta Alpha.
I guess I didn't know.
Bryan, thank you for joining the show today. We appreciate you coming on.
Ryan, thanks a bunch. Appreciate the opportunity.
Well, Bryan, you're one of the thought leaders in our space. Keep a lot of broker-dealers educated on macro environments and due diligence. I was wondering if you could share some of your insights on this episode about kind of where we started end of 2019 and then kind of what you think has happened, maybe the response to coronavirus, where we are and getting back to normal, and then maybe some items that we should all be thinking about, wealth managers, allocating to alternative investments, and maybe share some insights from, past business cycles of things that may or may not come to pass that we should be keeping our eyes on from people that we've, invested with.
Sure. Well, I think towards the fourth quarter of 2019, generally speaking, things were humming along. You had a reasonably positive, or you had a positive GDP, and, it was business as usual. I think, second half of 19, there were a lot of, on the real estate side, there were actually quite a few asset classes that were kind of nearing cycle tops, and we were starting to see some cracks, storage, and understand, real estate, of course, individual projects, they're always underwritten at the local basis, right? The sub-market, because those are dramatically different, MSA to MSA. But for instance, on storage, we were starting to see, some vacancy numbers ticking up, an oversupply issue, that kind of thing. We saw some in multifamily. Most of the top 50 metros were kind of at the apex of the cycle in multifamily. And so continuing into first quarter, the COVID-19 crisis obviously threw a wrench into everything. And I think at this juncture, it's a little too early to prognosticate. Many have, and I think you can certain asset classes within the real estate industry, you can be pretty confident in. In fact, their performance is probably enhanced, if you will. Those, you've got the traditional four food groups: office, retail, multifamily, and industrial. But then you have these other subgroups: senior housing, student housing, storage, et cetera. Logistics, to a degree, that's an industrial plus. But if you look at, data centers, for instance, anything significant logistical facilities, Amazon related, et cetera, those are doing fine. Multifamily, from what we've seen so far, we think the Class A new stuff and the Class C workforce will probably be adversely affected, or affected the most. I mean, the C properties is kind of obvious. A lot of the service industry employees were the first to lose their jobs, and frankly, those jobs will probably be laggards in coming back, given the localized and statewide orders on restaurants, bars, et cetera.
No, it is interesting. I mean, it's been kind of also a pause, given that a lot of local governments and kind of third parties, engineers, appraisers, have kind of had this shelter in place. Non-essential transactions, real estate transactions, aren't happening, and so as that starts to get relaxed, maybe as the country starts to reopen, what do you think? Maybe the haircut to purchase price for like an office building or a retail center. How do you see the underwriting changing in the next 6 months? How are you going to stress test the underwriting going forward?
Well, there's going to be some, permanent partial reset for an extended period of time. I think in certain asset classes. I mean, you look at office. Those small businesses that actually survive this, small to medium, and maybe segments of Fortune 500 companies for that matter, are going to analyze their various, functional areas. And if there are, salespeople, engineers that can do their CAD stuff on their laptop at home, whatever the case may be, they're going to look at, okay, what was the productivity during the COVID, separation, work at home time frame, and the productivity otherwise. And there'll be employees that are making the case, hey, listen, here's what I did from my sales goal perspective, and I want to continue this. Now, a lot of people have, say, small children at home, and they may say, nah, this is not for me. I want to go back to the office environment. But there's going to be a segment of the office users that disappear or, reallocate, if you will, their location. So that's going to be hard to, determine, but we'll definitely be looking at tenant rosters and, use and the rent roll and the expiration dates, and figure out, how these tenants are doing within the different projects. Multifamily, it'll come back. Obviously, the real stress right now, multifamily is probably one of the areas where there's still some financing getting done. The problem is, if you look at, you would think, and most people watching this know, the valuation of real estate is a three-step process. It's the 10-year treasury, it's the spread over the 10-year from the lender's side, and then there's a spread over that for the owner developer taking the risk of owning a non-liquid asset for a long period of time. I mean, positive leverage is what makes real estate work. So if you look at 12 months ago to today on the 10-year treasury, the 10-year treasury is down 90 basis points. The problem that we run into is twofold. One, the GSEs, Fannie and Freddie on the multifamily side, are putting floor rates on their quotes. So if you've got a floor rate of 90 or 75 and you've got a higher spread up to 250, 275, you're getting back to that 4+ number, whereas a lot of these deals were being financed at 300 basis points sometime not too long ago. So that's going to affect valuation. What we've been doing on the multifamily, and we look at a lot of the 1031 DST product, probably 80% of at least the universe in the broker dealer independent RIA channel. And what we've been doing is we're taking rents flat for at least 12 to 18 months, small increases. And again, it depends on what Reese and CoStar is feeding us from a local MSA perspective, right? But generally speaking, that's the approach. We're going to tick up the vacancy by anywhere from 500 basis points to 10%, and we're going to play that out for 18 to 24 months, and then we're back to normalizing. Rent growth, expense growth, vacancies back to where they were, say 12 months ago. In that particular market. So the early stuff, the early holding period, we're testing hard, and then we're doing our standard 10-year Argus modeling on the exit.
On the retail side, are there any kind of major credit tenants that you guys are worried about that, people like Chipotle or some of the big box retailers have said we're done paying rent until further notice? Is there anybody that you think is going to be really, really poorly situated post this normalization?
Well, I heard yesterday. Well, to preface this, we still look at a lot of a fair number of triple net deals. We got a little bit wary of triple net just to the direction of cap rates over the last few years, and early on we were wrong, and I guess COVID makes us right, but there just wasn't a whole lot of juice. You know what I mean? So you've seen some of the public stuff, Subway, Mattress Firm, Cheesecake Factory, where the franchisors are either coordinating with their franchisees or groups of franchisees are saying, we can't pay rent and we're not paying rent. There are more out there. We work a lot with the Boulder Group out of Chicago, Jimmy Goodman and Randy Blankstein, and they've got a good pulse on the national, triple net market, and they say there's more to come. Now, on the flip side, Tractor Supply yesterday said they were increasing their quarterly dividend, so their stock was up and their credit's still good on the triple net side. But there's going to be big empty boxes, and you can kind of guess who that might be. I mean, my niece is furloughed. She lives in Manhattan. She's furloughed from Macy's. Will Macy's close some stores? There's discussion the last couple days about Neiman Marcus filing for bankruptcy. So, there's going to be a fair amount.
Yeah, and it's interesting. The retailers, the grocery stores, right, have kind of really proven the necessity to have bricks and sticks, but a lot of those folks don't pay a huge amount in rent on a per square foot basis like the rest of the tenants in those strip malls. But I do think it's going to put some interesting dynamics in play about the importance of some of these retailers, or at least communities appreciating the fact that there's a Kroger or a Whole Foods down the street, because a lot of grocery deliveries are not happening because there's a surge in demand for these kind of Amazon grocery providers. So I think it's gonna hopefully give a boost in the arm to some retailers, but it's definitely hurting the viability of a lot of others. Can you maybe touch?
Sorry to interrupt you, but grocery anchored, I agree. I mean, the grocery stores pay $6 a foot, and the inline tenants might be at 18 or 20. But that grocer's rent check right now is a highly appreciated thing, because at least
is debt service.
Yeah, it can cover a chunk of debt service. But I used to we have our real estate symposium in Scottsdale every October, and we were talking October 18 and 19, just kind of the twilight zone of how can it get any better in commercial real estate. And at the time, the whether it's grocery anchored or non, neighborhood shopping centers, I said for the cap rate you pay, that's probably the best risk reward opportunity on stabilized assets, because shoot, even in a bad recession, people will pay $6 for a Chinese lunch, and they'll go to the dry cleaners and they'll get their hair cut. Well, guess what? First time in the history of the world, all three of those tenants are down. So all bets are off in the COVID world.
Yeah, no, it's going to be interesting to see how long this lasts. Maybe you could touch about hotels. I mean, those poor owners have been decimated. I think occupancy rates are like at 20% right now nationally. What do you see in store in the crystal ball?
I took a recent trip to Manderson, Wyoming. I had to spend the night in Rapid City, South Dakota. And granted, that's Rapid City, South Dakota, but I think it's happening all over the country. I paid $19 at a branded select service hotel, and I wonder whether that barely covers the variable expenses. But yeah, the hotel industry has been hit hard, and again, it will be a slow climb back. The development deals are probably okay if you're just now buying the dirt, or maybe you've been working for a few months and you got the site prep done, because the delivery on that will be 18 to 24 months out. So all other things considered, right? The right market and the good quality financing and all that, wouldn't be too afraid to do a hotel development deal today. But on the quote unquote stabilized, they are highly unstable right now. You have the Paycheck Protection Program loans where the hotel franchisees qualify. And that will, if these are all funded with the additional $484 billion they approved this last week, I think 250 of that's going, if memory serves me right, 250 of that's going to the Paycheck Protection Program. So the franchisee can run for another, 60. The rule is 60 days after your date of funding. So if they're, on life support but paying all the bills right now with a furloughed workforce, 60 days from a week or two or three from now, you'll get through some of it, but then what? And now, one of the nice things about hotels is that operationally it's all labor, most, not all, but significant labor expense. So, that's a variable component. So you had a staff of 18 running that hotel, you're going to be down to 5 or 6.
No, I heard something crazy, like it's at $900 billion, almost $1 trillion of revenue that's going to be lost this year in the hotel industry. So that's a big donut. It's going to impact capital structure, and so I think it's going to be wildly disruptive to that industry. But you mentioned the human element, which is like the unemployment rate. And maybe we go back up to like a macro level. I mean, we might be at a 20% unemployment rate today, maybe higher. What do you think is going to happen in the economy over the next 6 to 12 months? I mean, we had tremendous stimulus, tremendous demand destruction. Is it enough? Like, what do you think is going to play out?
No, because stimulus only works for so long. Stimulus is I don't want to, calling it a Band-Aid is probably too harsh, but ultimately the fundamental economic drivers have to be at play. And that is, primarily full unemployment, a consumer that's confident and is spending. I mean, 70% of our GDP is on the backs of the consumer. And if the consumer isn't going back to some of those activities, and think through it. I mean, we're talking about hotels, restaurants, bars, movie theaters. The daily life of the consumer will not be the same. So early on in this, early on being 5-6 weeks ago, people were talking about, oh yeah, we're going to have a V-shaped recovery and everything's going to be normal in the third quarter. Well, I think they've thrown the V out. I think you can throw the narrow U out. I think you can probably throw the U out. We're looking at a Nike swoosh, sorry. And that's what it's going to look like. And I think it's going to take longer than 6 to 12 months. And again, there may be a little bit of a permanent reset. We may be talking to each other 3 years from now, and the general consensus from the macro economists, who are a lot smarter than I am, might be that 6% unemployment is full unemployment. It used to be 2%, right? Because of the people that, quit looking, and then, part-time teenagers and whatever else. But that number could change.
No, that's an interesting, point, that the earnings curve, I guess, is going to get dragged out until we really buy, hopefully, a catalyst in the healthcare space, convince people they're safe again to start traveling and going back to the office. One question I had for you. Yeah. And I think until we do that, I think people are going to continue to be skeptical, given all the mistrust of whether it's fake news or propaganda or an administration they don't buy into. I think the lack of trust and partisanship is forcing the general public to kind of pause a little longer than I'm sure a lot of people would like. I think one question is, do you think we're at risk of a depression if we don't get the municipal bond market sorted, or if we don't get back to work? I mean, is there a risk that we get the policy wrong here and we go into a real sharp depression?
Boy, I don't know. That's probably above my pay grade. You would think that the interim fiscal stimulus would help with that. I don't know. I don't think so. I think it's a severe recession unlike we've ever seen, of course, at least in the short term with the unemployment numbers. Um, and we don't want to get too political about this, but you start to question the resources and the restrictions and everything else for the pick your number under 50 healthy people, right?
Yeah.
Absolutely. Well, switching gears a bit, I mean, the oil and gas space has been really volatile. Never in my life did I expect to see negative oil prices. Maybe you could share some of your thoughts on the oil patch.
Right. So, and I don't want to, I don't want to engage in too much promotion here, but just last week, Brad Updike is our lead energy lawyer in the office. He does most of the work on the energy space, and that is, drilling, royalties, minerals, MLP, infrastructure, all that. They did a podcast. Brad did a podcast with Steve Burr, our lead petroleum engineer out of Dallas, and a gentleman named Dan Steffens, who's a consultant in the industry, very experienced and well respected. So that podcast is up on our website, micklawpc.com. That goes into a lot of detail. I think and this is true in some aspects of the real estate space. One thing, by the way, we should point out on the commercial real estate side, generally speaking, the trough across the board is going to lag the general economy by a good 6 months, if not more. So the real estate opportunities, even if you see positive GDP numbers in the fourth quarter of 2020, the real estate opportunities may be 12 months from now. Now, getting back to the oil patch, right? So the prices now require somebody to pay you, a producer to pay you to take his oil. That's going to normalize a little bit, and there was a little bit of blame on the massive ETFs and computer trading driving some of that price collapse. But clearly, demand is way down, and it ties back into what we've been talking about. Are you going to go to a vacation to a crowded beach or a crowded national park? The Yellowstone attracts hundreds of thousands every summer. Are people going to be elbow to elbow at the geyser? I doubt it. So you have a demand, a softening of demand. I think the Saudi, Russian thing's getting fixed a little bit. But a softness of demand is going to continue. So what do you do in in our world, the private placement world? There's opportunity, obviously, right? You can buy minerals on the cheap. You can do royalty deals. The nice thing about doing royalty deals, you buy the royalties and it's just an IRR consideration. If the privates and the publics that have the capital to drill, well, they're not going to drill today, and they may not be drilling 12 months from now, but eventually they will. So if you can buy those royalties today on a discounted, a prospective discounted cash flow basis that makes sense, that's probably a pretty conservative way to go about this. The thing that drives me crazy, and you've seen this too, of course, the retail investor, behavioral economics comes into play, and the retail investor gets scared at the time when he or she should be jumping in with both feet. I mean, Warren Buffett, our neighbor down the street, be greedy when others are fearful, and fearful when others are greedy. And he hasn't deployed a lot of his 180 billion in cash or whatever they're sitting on. Last I heard, at least publicly. So there are opportunities. Remember the early 80s when we were down to $10 a barrel. Folks were buying drilling rigs and other heavy field equipment and, storing them on the back 40. They were buying at 3 to 5 cents and storing them on the back 40. And, 5-6 years later, they made a lot of money. So you just have to think creatively and have the stomach for it. And look at some of those opportunities.
Yeah, and one area that has been interesting to watch because it's been litigious with the IRS is conservation easements, and it makes a lot of sense to have that product in place by letter of law. It's allowable. It protects our environment. I mean, as an outdoors person, I enjoy seeing some of these projects be kind of manicured and put together for future generations. Maybe you can give a state of play of what's going on in that industry, because it's been a very interesting posture for the government to take on some of these projects.
Yeah, and I don't, even though the IRS is busy with other stuff right now, I don't think they're going to back off on trying to, uh, you know, you can use prosecute or persecute in this discussion, I think. Some of the folks that are active in that industry, uh, I'm in your camp. It's Section 170H. It's allowed. It was reaffirmed by Congress, 10 years ago, 12 years ago, whatever the date was, and made permanent in the tax code. And again, it's whether it's a conservation easement or a real estate development deal, it's all about the assets. So if there's economic substance to the transaction, it can be underwritten and validated, at least on the development option. Then a conservation easement properly structured, yeah, it's very complicated. There's 92 things you have to do right, but it remains a legitimate, powerful tool for high net worth, or more appropriately, high income people. So we'll see. I know there are at least two, active sponsors in the space who will do multiple programs this year. Now, uh, the issue, of course, in 2020 is, what's the demand component of that look like? If you're a small business owner, or you're an executive who either voluntarily or involuntarily took a big pay cut, you're not going to be looking at a CE or oriented investment. So
Well, that's a great point. Like, the environment is also throwing a monkey wrench in opportunity zones. Maybe you can give us an update on what you're seeing there.
yeah, we haven't looked at any new opportunity zones probably in the last. Well, I take that back. Kyla did one, Urban Catalyst, and I think they're going to um, shelve, for 90 to 120 days, and see if there's more clarity on a couple of their pending projects. You know, it depends, I guess. No, it doesn't really, because most of the opportunity zones have been in the last, call it the last 6 to 9 months, legitimately. I mean, at least in our space, there were folks when they passed the regs in October of 18. There were folks that jumped on it right away. Right, I've got an opportunity zone. I'm going to raise $700 billion. Well, it's a tale of two cities. The deals that we look at, the smaller private deals we look at, whether it's a one-off project or a fund structure, and then the larger, wirehouse name on an opportunity zone. Those two segments of this space have been pretty successful in raising capital and deploying that capital. I think it's the folks that ran out there and thought they'd, start a fund and then partner with developers and contractors later, are really kind of languishing. And even before COVID, my position was there's going to be some ozone dirt that's on sale in 2020, because a lot of people were focusing, and I think it's a red herring, a lot of people were focusing on the 5% basis bump that expired at the end of 19. If it's a quality project, there's still a lot of horsepower in an opportunity zone. So, you look at Peachtree, for instance, their fund is going to end up with, 10, 12, 15 assets. They've only CO'd one. They're in development on, 3 or 4 others, and then they have some dirt under contract and stuff they're still looking for, and quite a bit of money in the bank. So I think, I don't have a crystal ball, but I think that fund over the long term, remember, we're talking 10 years, is going to do fine.
We've taken the position, we've only done project level opportunity zone investments, and a lot of our advisors who participated look like heroes because they kind of forced some of their clients to, take some profits Q4, and that was the right call. Whether the reason and rationale for that was an accurate call or not, but the question is, structurally, has the Treasury Department come out and fixed some of the uncertainty around fund vehicle and some of the fee structures and the promote? Has that all been clarified in the last few months or last 6 months?
Yeah, it has. There was a final set of regulations that was out probably, oh gosh, 60, 90 days ago. And I apologize. We have our underwriter and our lead lawyer in that space that kind of handles that stuff. I mean, I look at everything that goes out the door, of course, but yeah, I think there's plenty of guidance now to be comfortable doing a project.
Private equity and kind of venture capital. I mean, maybe you can talk a little bit about, there's been a lot of money raised over the last few years, vintage years, for private, growth equity and venture funding. What are your views on those markets today?
We don't do a ton of that work. We have, a few deals every year we look at, I suppose. It's tough. It's tough in the kind of retail IBD RIA space, just because there's a filter, So when we're looking at it, is it a project that would have, if it would otherwise have been funded, by a large wirehouse or investment bank, then we're probably not looking at it. And it depends too on the size of the deal, of course. But again, if your financing sources on the debt side are questionable, and you have capital to deploy in this environment moving forward over the next year or two, there's a lot of opportunity. Absolutely.
So that's on the equity side. On the other side, the private debt side and BDCs, I mean, what are you guys hearing, and what are your thoughts about that market?
They're going to be crushed. I mean, I have a personal bias, frankly, against a lot of the non-traded REIT and BDCs. BDCs, the larger risk that's been omnipresent on the BDCs is they tend to borrow short and loan intermediate to long. So, intermediate. So you've got potential spread issues there. They are lending to non-investment grade subjunk for, I mean, that's the function, right? So they're going to be operationally challenged.
And maybe this is just more of a market commentary of the industry, but there's been a lot of consolidation in the broker dealer channel and the RA channel. What are you hearing from your clients? Are a lot of them doing well? Are they under pressure? Is there a need to consolidate further?
I think it's the question number one is, I think it's too early to tell on how they're doing, and it's I'm assuming a number of our clients, as have we. I mean, Bryan Mick's 55, and I've never taken a dime from any governmental entity in my life. But when they came out with the Paycheck Protection Program, my juicy rationalization was, I'm just getting the down payment on the multiples I'm going to have to pay down the road to service where are we at now? 2.8 trillion in debt. By virtue of this crisis. So
yep.
I applied, and we're going to use it. And I'm sure a number of our clients have too. I hope everybody's keeping folks employed. That's our plan here. And, we haven't made any adjustment. We've made adjustments on the logistical side, of course, as everybody has, but we've made no adjustments in our employee base and don't plan to. So I think it's a little too early to tell. I can tell you this. I mean, if you're a broker dealer that has, your rep base is focused in a certain area, for instance, 1031 DSTs, that's slowed down substantially. I think there's still demand there from the investor side, but how is, as a sponsor slash issuer, how do you value this deal? How do you negotiate this deal? Can you even get a loan commitment? And what's that look like? And are they gonna price you at the close so you don't know what spreads are going to be like when you're ready to close in 60 days? I mean, there's a lot of uncertainty out there. So, there's if you're practicing in a particular area or heavy in a particular area, it can be significant. And then on the consolidation question, absolutely, there's going to be more consolidation.
The SEC's asked sponsors to put out these COVID supplements. Do you think sponsors are maybe some of the ones that you've reviewed, or if you've seen any, are they being realistic in their earnings impacts, or do you think there's probably going to be future supplements that need to be written as time goes on?
Well, on the public non-traded side, I would say they're probably not being realistic. The NAVs that are being reported, of course, from Q1, obviously they're suspect at this juncture. Q2 is going to be significantly worse. I wish they would take, and I shouldn't paint a broad brush, a few are, but you really need to be proactive. Everybody in this industry needs to be proactive, from the sponsors to our due diligence firm, to you running your business, and down at the rep and client level. You need to be, if there's bad news, the old mantra is you talk about it early and you talk about it often. And we've seen leaders in the industry and how they operate the last several weeks versus others who are hiding under a rock and not communicating. And the former are going to hopefully salvage their business, solidify their reputation, and do phenomenally on the back end of this. So,
well, I don't know if you been following RegBi, but what are your thoughts about how it's going to impact the alts industry? Do you think RegBi is going to preclude sponsors from participating in any other piece of the wealth management channel, or where do you see the line in the sand on delineating conflict of interest and eliminating it as it relates to the marriage between asset management sponsors and wealth managers?
Well, our concern with RegBi, and I don't want to engage in self-promotion here, but we have said since FINRA 1022 that if you are going to analyze, quote, and this is FINRA's language, the business prospects of the issuer or the achievability of the sponsor's projections, you have to underwrite the asset. And before that, we're underwriting assets. It's all about the deal. You need to make sure disclosures are appropriate. You need to make sure that fee structure, splits, carried interest, all that are appropriate. But at the end of the day, it's the asset that carries the investment. So we believe with RegBi, from the commission perspective and comparing products, it is highly justifiable if you have two Class A multifamily projects in similar markets, that if one of them has a holding period 10-year underwritten IRR that's 200 basis points over project B, then of course you make that decision based on the two available at the time, and you can justify a higher compensation structure on a better performing asset. It's going to come down to the due diligence that's done at the dealer and rep level, and who they utilize to help underwrite the project. And if it's properly documented, RegBi should be a non-issue.
And so, Bryan, I guess a few questions. So what have you been reading during the quarantine period, the work from home period? Have you been reading any interesting books or any market insights, people you've been following that our viewers should think about reviewing?
Dang, put me on the spot. The Spider Network It's a book about the, inside game on LIBOR and the manipulation of LIBOR, which, by the way, we'll all be dealing with. I think that's the end of 2021 where they dropped LIBOR. That's been a very interesting read. I have to confess, I read a lot during the day. So at night, we've been hitting the Netflix really hard. Most of them are favorites of, a new series or a new season coming out on old favorites. Yellowstone, Schitt's Creek, that kind of stuff. On the business side, though, just trying to make sense of everything. There's plenty of sources out there, sometimes conflicting sources, and like we indicated in our recent Adisa article, there's a lot of postulating and speculating, but we're in uncharted territory here, so you have to weigh in from that perspective. I did notice I've always stayed on top of John Grisham. I see that there's 2 books now, and I'm cheap, so I wait for the paperback. So maybe I'm not; those aren't available yet. But I'm looking forward to the next couple of Grisham books and Barron's. I mean, yeah, I think pound for pound, Barron's is about the best source out there, right?
Yeah, I agree. I've been doing a lot of Audible lately, and Fauda on Netflix is pretty good. Highly recommend that. But, well, Bryan, I really appreciate you joining us and sharing some of your insights. And we'd love to have you back on the show in a few months' time as this starts to unpack itself and we have more underwriting visibility.
Bryan, thank you. I really appreciate what you're doing for the industry and getting out the information that can help people make decisions.
Thanks, Bryan. Have a great day.
You too. Bye-bye.
Thank you for watching Non-Beta Alpha. Before we go, please remember to subscribe and leave us a review on Apple Podcasts or our YouTube channel. This is Non-Beta Alpha. Now you know.
Give it time.